We looked at redemption techniques, the Zen's case. Now, let me talk to you in general about buy-sell agreements, because this is really what I'll call practical stuff. Buy-sell agreements. Many of you, I would imagine, have shareholders. Your first client is not IBM, and many of you are going to have clients who are much smaller. They're 2, 3, 4 people who form a business, and they need your assistance. And one of the first things we're going to ask is choice of entity, right, from Chapter 1. Everyone agree? And you're going to point out to them the pros and cons of different enterprises, including S corporations, C corporations, LLCs, right? And they may opt for one reason or another to be an S or a C, right? And what is one of the first things you should, in your repertoire of questions, insist, or at least go on record saying you recommended that they have? Some sort of shareholders agreement. You can go under several different names: shareholders, buy-sell agreement, or the like. They come in 2 preliminary flavors, right, guys? They come in 2 preliminary flavors. Cross-purchase, so if you have 2 shareholders, A and B, you cut out the corporation. If something happens to A, B agrees to buy A shares, cross-purchase. Or alternatively, you could have a redemption agreement, right? Where the corporate enterprise, whether it be an S or a C, agrees that upon an event that a redemption, speaking of redemptions, a redemption would happen. Now, what kind of events do we have in mind here? Tyler, do you want to give us an example of an event? Just one. That's not what I had in mind. Dion, what kind of event might happen as triggering one event to a buy-sell agreement? Let me just get Dion. Dion? One event? All right, you guys think so morbidly, but I'll take death, right? We could have death, retirement, and disability. Typically, someone just mentioned divorce. I mean, not too many husband and wives I know have, buy-sell agreements. It's not a good sign of a marriage. They have prenuptial agreements. What was that? Well, that's a prenup, but not a buy-sell agreement. All right? Certainly, the most common is death. Disability sometimes is hard to define, okay? So be forewarned. The fact that someone would rather golf than work doesn't mean they're disabled. You may think if they're your colleague that mentally they're disabled, but that doesn't mean that they're disabled. Albeit, some people, are there any golfers here? No one, not a single. See, now, Ali, you're a golfer. You're a golfer, Brian. Do you have this, like, if it's a sunny day, do you do you get jingly, like you need a fix, like to go out there? Because I know some people who so love golf, and when it's nice out, they have trouble sitting at their desk. You're not like that, Brian? Any of those people in the? You took the day today? All right. See, you're. I know those people. But my point is, some people might say you have a disability because you're addicted to golf. All right. Oh, so you go out to this good stress reliever? Anyone else have any good record aside from hitting golf balls? Any other good stress relievers out there, guys?
After June 29th.
Oh, June 29th is a stress reliever? All right, I hear you. I'm talking about a physical activity, not a mental activity. All right? All right, so maybe I will share with you. I had to go. How many of you have been in this room to Mohonk Mountain Lodge? Anyone? No one? You've been there, right? Okay. It's in New Paltz, New York. If you haven't been there on your bucket list, okay, and it's very close to here, and it's a real shame that only one other person has gone there. I'm telling you, it is one of the most exquisite places in an hour's drive from here. That's a mandate. If I could have our brunch there, I would have it there. Seriously, it's spectacular. And it has the neatest walking paths on the eastern seaboard. Am I saying that right? Do you share my opinion? During the fall? I'm sorry, during the fall? Yeah, the foliage is really... Now, it's also, be forewarned, it's extraordinarily expensive. Now, here's the one thing. So the hoi polloi, like myself, I'll speak for myself, you don't have to stay overnight. They have day passes. So you pay, I think it's $10 or $15 a person. If you want to stay overnight, be forewarned, you're talking for just two people, easily $700-800 to stay overnight. It's a little bit, or should I say parenthetically, a lot beyond my price range. So you might consider, though. It is spectacular. Anyway, how did I get there from here to here? I'm sorry? Stress relievers. So I went there on a day visit, and they had a meditation. And some people would say, I need that 24/7. They had a good quote from that meditation session, so if I can, I'll look for that email that you want to delete. You can add it to the list. I'll see if I can find that quote. All right, so there's events that trigger buy-sell agreements, right, guys? But aside from the events, what is the most critical, in my mind, critical part of a buy-sell agreement? In other words, aside from the triggering events, what other things do you have here that make it very useful to have a buy-sell agreement? In this context, Christina, do you have any, what makes it a buy-sell agreement very useful, Christina? What else can you, either Larry, you want to tell me? What makes a buy-sell agreement uniquely useful? That's kind of me talking cryptically, but, and Christy, you shouldn't be able to read my mind. So anyway, what might that be? What I'm really driving at is the value, right? In other words, by using a buy-sell agreement for this closely held business, the reality is, who the heck knows what it's worth, right? And if, in this case, if Fatima and Israel are partners in some sort of, when I say partners, shareholders in a common enterprise, and Fatima decides if they don't have a shareholders agreement, and remember, there's 100 shares, Fatima has 50, Israel has 50, and let's suppose Fatima is not looking too well that day. Israel might say, gee, this stock is virtually worthless. And Fatima might say, no, this is very valuable because, God forbid, something happened to Fatima, she will want Israel to buy her shares for a lot of money, right? So the time to negotiate what a shares are worth are not when you're very ill, right? That's never a good time to start the negotiation process. So what does a buy-sell agreement do is when the parties are, in theory, at an equal level, Fatima and Israel can join forces and decide, gee, should it be 6 times our multiple of our earnings? Should we just fix a value, a certificate of value, and say each share is worth $10 and that every year we'll adjust it? Or should we have a certificate where it just says that that every several years we'll have our accountant adjust it? Make sure your accountant's willing to. That's a tough place to be put in, so I don't know if you really want to be there. So I'm going to see in the margins of my book that the definition of value is extraordinarily important in these buy-sell agreements. Now, let me just ask around this room, again, by way of experience, aside from Mohonk as being such an important place, how many of you have seen buy-sell agreements in this room? Wafa, that's you? One person? 2? Dion? Ryan, you?
Is it same shotgun agreement?
I'm sorry?
Is it same shotgun agreement? Shotgun?
I don't know what you mean by that, though.
Shotgun is actually, A or B, they have obligation to buy. So that's why it's like the shotgun.
Like a shotgun wedding? I don't know. I mean, I have only seen it. You don't want to think of a shareholders agreement as a shotgun. I mean, it's the antithesis. You're supposed to, like, avoid the pregnancy, so you don't get into a shotgun. If I could.
Because actually, when I was in Canada, actually, in Canadian rule, we call the shotgun. The reason is that their partner, there's a conflict, they should buy or sell. They have obligations. So that's why there is restriction on transfer of their shares to other people.
You know, again, I can't speak to that issue. I mean, you as advisors want to put them in the position where the stress is not in the picture. And by having a shareholders agreement, for example, if you have an S corporation, why do you need a shareholders agreement? If you have an S corporation, come on, guys, why do you need a shareholders agreement if you have an S corporation?
It's a class 2 MGP.
But who cares? I mean, so what? You don't need a shareholders agreement. Say again? Well, what? Give me a parade of horribles. Think evil if you don't have a shareholders agreement. Yeah, you could sell to someone who would violate your S Corp election and thwart. So suppose you have 100 shares and you give 1 share to an employee, and then your employee says, listen, you either triple my salary or I'm going to sell that 1 share to someone in the Cayman Islands who doesn't qualify, right? As a shareholder, if you look at Code Section 1361, it has to be a U.S. person or a resident. It cannot be a non-resident. So if you don't triple that person's salary, they can thwart your S election. So in my opinion, if you don't say to your client who has an S corporation that they should have a shareholders agreement, and subsequently the wrong people get a hold of it, I think you got a malpractice suit on your hands. I think you really have to be on record that you strongly implored your client to have a shareholders agreement or risk, professional liability. All right? So shareholders agreements are critical on several different levels. They provide a ready market for shares that are not marketable. They define a value, and they protect against shareholders that you don't want in the picture. Often people who work together don't want the other person's spouse in the picture, right? They don't want that person's spouse in the picture. If you don't have a shareholders agreement, or they don't want that person's children in the picture, you need a shareholders agreement to limit the right to whom they can gift or bequeath shares to. Constructive dividend issues. Okay? We talked about constructive distribution. This is the same sort of thing, but in the redemption context. Remember when we talked, Michelle, you had a question? One's with a corporation, one's with a partnership. Same philosophy, identical philosophy. Or, Michelle, add to your repertoire, in the context of an LLC, what do you call it? Everyone, just at the cocktail party, you call it a operating agreement, right? So, just again, language is important here. You have a shareholders agreement, partnership agreement, or an operating agreement, right? Constructive dividend issues. They go through different situations in Revenue Ruling 69-608. When a redemption may give rise to a constructive dividend. And what you look for here, the operative, my takeaway of this revenue ruling, is if a shareholder has the primary obligation to fulfill a redemption, has the primary obligation, and in some form or effect instructs the corporation to fulfill that obligation, that's a problem. When I say that's a problem, if the corporation assumes your obligation, take the aroma test, what does that feel like to you? If the corporation, you remember from Old Colony Trust, from income tax guys, if the corporation pays your tax burden, is that income to you? Yes, Code Section 61. If a corporation fulfills your obligation, you had the obligation, but you had the corporation fulfill your obligation. What does that become to you?
Income.
Not income necessarily, but a constructive distribution to you. All right? And we know we're back to Chapter 4 and Code Section 301C1, 2, and 3, right? So this revenue ruling addresses different scenarios where in some cases the taxpayer was primarily obligated, like situation 1 and 2, and other situations where the shareholder was not preliminarily or primarily obligated, and it did not give rise to a constructive distribution. All right? So, look, aside from that, I think everything in this revenue ruling is pretty straightforward. I think you guys can handle it. Let's look at the problem on page 257. Problem. A, B, and C, who are unrelated, each own 1,000 shares of common stock. The only class outstanding of X Corporation with a fair market value of $400 per share. X has $600,000 accumulated and no current earnings and profits. A and C each have a $50,000 adjusted basis in their X stock. B, who recently received her stock as an inheritance, has a $400,000 basis. B wishes to retire and dispose of her stock. Okay, so I have a little picture in my notes. Let me just see. Somehow I thought I had a working black magic marker. Oh, let's see if this works. And we have X, and we have A, B, and C. They're unrelated. They own 1,000 shares of common stock of X with a fair market value of $400 per share. X has $600 accumulated. This is not a great. And 0 current earnings and profits. Striking out here. A and C each have a $50,000 adjusted basis in their stock. B has recently received her stock vis-a-vis an inheritance, and that means Code Section 1014 applies, right? Basis is equal to fair market value, has a $400,000 basis, right? What are the tax consequences in the following alternative transactions? Pursuant to a cross-purchase buy-sell agreement, B sells 500 shares each to A and C for $200,000. Let's repeat that. B, pursuant to a buy-sell agreement, B sells B has 1,000 shares, but B is going to be out of the picture, selling 500 shares to A and C. Okay? And B is going to retire. Are there any tax consequences to B? Are there any tax consequences to corporation or A and C? So in this case, not designed to be a trick question. Akash, any tax effects here? To B. What code section comes to mind? $10.01. Any gain or loss here, Akash? And Wafa, see if you agree with his answer. Wafa? Agreed, right? Amount realized, $200,000, adjusted basis, $200,000, no gain or loss. Brian, any effect here to the corporation? I'm sorry, you're whispering. No effect, right? It's happening between and among the shareholders. Not going to have any bearing. Corporation has no gain or loss. All right? So your note's pretty crisp, right? No gain or loss to B, no effect to A and C, and no effect to the corporation. Yes? Yes, they would each have a basis of 200 under what code section? 1012, right. Perfect. They have a cost basis, right? A and C have a cost basis of 200,000, code section 1012. Agreed? Agreed. Question B. Pursuant to an entity purchase buy-sell agreement, meaning a redemption agreement, X redeems all B shares for $400,000. Does B have any gain or loss here in this context? Ehor? And Gary, see if you agree with Ehor. So does B have any gain or loss? You're whispering now, Ehor. So what do you say? B have any gain or loss here? Gary, agree? No gain or loss. Any effect, Gary, to the corporation? Gary? None. Allie, would you agree? Any effect to the corporation? Priscilla? Andrew, any effect here to the corporation? Angie? JP? What are our choices here, guys? Remember, because you have your outline for the course, does 311 apply here? Does 312 apply here? Why? There was a redemption, right? Right, Ellie? So what's going to happen to earnings and profits? By how much? How much? Irma? Irma, where did you come with 400,000? But is that what we look at with the redemption? It's 312N7, which says it's pro rata, right? To the percentage. Here, 1/3 of the shares were redeemed. What effect on earnings and profits? 1/3 of the earnings and profits, right? Matt capped at the amount of the amount being distributed, but here that's not a problem. So it would be $200,000, right? So for your notes, B has no gain or loss. The earnings and profits would go down by $200,000. Agreed? Good. So you got that? The corporation has no gain or loss, but its earnings and profits go down. All right? Say again? Your light's always on. I think it's on. Is this yours? All the lights are on. I just see lights. All right. All right. All right. So, guys, for your notes, question B. Again, no gain or loss to the corporation. B has no gain or loss. The only effect here is the earnings and profits would go down by 1/3. I'm not touching it. Question C. Same as A, except that the agreement required A and C to buy B stock over 10 years with an appropriate interest, but they did not have sufficient funds to make the payment. So A and C looked at each other and said, gee, well, the corporate enterprise, which is flush with cash, we'll have that entity make the purchase. Okay? You get the visual? Edwin, any effects here to B? Tyler, any effect? To B. When you say constructive, B's getting real cash. Lee? Fatima, Israel? Fanta? Any effect here? Does B have any effect? What's B's basis? 400,000. What's the amount realized? 400,000. I mean, it could be an installment. No, but there's no gross profit ratio. So essentially, it's zero, right? What about the earnings and profits of the company? Irma. What percentage of the company is being redeemed? 1/3. The math has not changed on us, right? But here's the question, Howard. Here's the question, Kareen. Any effect to A and C? You're whispering, Howard. Can you tell me what it is? Kareen? Okay. Kareen, any effect here? Guillermo? Matt? Constructive distribution. Constructive distribution, right? Guys, isn't this revenue ruling 69-608? I'll repeat. Isn't this from the prior revenue ruling 69-608? It's identical to essentially situation 1 and 2. Weren't they primarily obligated? And they said, nope, we're not going to do it. We're going to have the corporation do it on our behalf. Okay. So the answer here, B has no gain or loss. The corporation's earnings and profits are reduced by its percentage of the shares being redeemed. But A and C here have a constructive distribution of how much? $200,000 each, right? Right? It's as if the corporation gave them each $200,000 to enable each to fulfill its obligations, right?
Is it 200?
It is. Yes. Or 1/3 of the existing accumulated earnings and profits at that time. Question D. A and C had options to buy B stock when B retired, but they were short of funds and allowed X to redeem the stock instead. So now the facts have changed. Right? In this case, given this, Hannah, what do you say? Given this changed fact pattern, what are the effects here? Say again? Same as B, which means what outcome? Does B have any gain or loss? No gain or loss to B, right? And the corporation will have its earnings and profits reduced by $200,000. And then A and C, do they have any tax effects? And the answer is no, because they were not primarily obligated. So under the revenue ruling 69-608, it's akin to situation 4. Since they were not primarily obligated, there is no rippling effect to them. So you just have to be careful here to see what the shareholders agreement says. If the shareholders are primarily obligated, you may be cooked. It was optional, right? Fatima, it's not mandatory. Question E. The parties previously entered into a cross-purchase agreement under which they agreed that the two surviving shareholders would purchase the X stock owned by the estate of the first shareholder to die. Okay? X purchased a life insurance policy on each shareholder and paid the annual premiums. Now, let me tell you, as a practitioner, I so often see this. I see where they have shareholders agreement and they want to fund the buyout by life insurance, but the wrong party owns the life insurance. So just be careful as a practitioner. What is the job of an insurance salesperson? Sell insurance. Do you think once they sell it, do they care less if it's owned by the wrong party? Do they care less if the wrong beneficiary's name? So it's up to you. I'm telling you, they couldn't, I guess I mean this in somewhat a derogatory way, but I'm telling you, generally, insurance people, their job is, very narrow. Sell insurance and move on. And you can't have your name associated with that as a professional. If the wrong party or the wrong beneficiary is named, you're cooked, you're toast. So don't just assume that the insurance person who says, don't worry, I have it all taken care of, don't assume it. And if they tell you who the owner is and who the beneficiary is, be a skeptic and say, oh, do you mind PDFing or faxing over a confirmation of owner and beneficiary? Because I've heard people tell me things and I've learned enough to say, okay, that's fine, but for my records I need it in writing, and you'll be surprised what you see. So don't go on faith, guys. There's a time to go to, whatever religious places you might go or not go, not when it comes to insurance policies. X is the beneficiary. Under the policies, B dies last year, and X uses the proceeds from the policy on B's life to completely redeem the stock held by B's estate. All right? So they're going to do it, but now the company is flush with cash. I'll just point this out. I mean, we never get into this. I'm just going to tell you, does the company, when it gets insurance proceeds, does its earnings profits go up? Sure. By the full amount? No. I'm just making an observation. Remember we said that earnings and profits were a better benchmark than corporate income as what is a company is earning. So let's say the insurance proceeds were $1 million and the company had paid in premiums of, say, $400,000. Earnings and profits would go up by the delta, or $600,000. Okay, someone dies, the earnings and profits would go up by that amount. Now, what effect here if the company redeems out B's shares, aside from the fact that it's redemption and the 1/3 of its earnings and profits will go down by 1/3? Is there a constructive distribution here, Jared? Is this a constructive distribution? Irina? Larry? Miss Larry? Not sure? Chloe? Paul? Leon? Constructive distribution or not? You think there is? Paul, agreed? Not? Chloe? There is, right? There is. A and C were going to be originally obligated. Now the corporation steps in. It buys back the shares. This is situation 1 from the revenue ruling. We're back to chapter 4. We need to know the earnings and profits, right? Because we're more, and I say this in a beloved fashion, we're more sophisticated than just calling it a dividend, right? We need to know, okay. Go, shoot, Christine.
It doesn't say anywhere in here that they have the option to buy.
That doesn't matter. They were obligated to buy.
But they didn't. X did for them. Okay. So that doesn't matter.
What doesn't matter? I can't say yes or no.
So it doesn't matter that they didn't have the option to buy.
Well, if they had the option, or you turn it, making it optional, then it does. They're not primarily, and then there's no constructive distribution. But if they're obligated to, meaning they have no option, and then the corporation steps up to the plate, that is a constructive distribution to them.
If they are not obligated, it's not a distribution, then what will be?
Nothing to them. They're bystanders. Right? You agree? They're bystanders in that context. All right, we're good?
So each one will get a half of the proceeds from the
They would get the proceeds, but that would be considered a constructive distribution. Depending on the company's then earnings and profits, they would have dividends of that amount. Page 258. Now, I don't know the pronunciation, Arnes case. And you tell me, John, do you have a chance to look at this? Read it a week ago? Do you remember many of the details? Shirley, you remember any? Or Brian? Or just JP or Angie? Andrew, Priscilla? Allie, Wafa, Eeyore? I hear someone whispering. Michelle, was that you? Talk to us about the case.
Okay, basically, this couple, they get together, really well. They open up this company.
What kind of company?
McDonald's franchise.
Yeah, I think we heard. Anyone hear of that company? They had a McDonald's franchise, right? They seem to be doing well.
Doing well.
And apparently it looks like they may have had one too many Happy Meals.
Yeah.
Because what happens?
Yeah. So several years down the road, money got to them. So
What happens?
money got to them and soured their relationship.
Okay, whatever. You're reading into it.
So anyway, so they divorced. So within the divorce agreement, they say, she's got to pretty much give up her.
Well, is it their choice or McDonald's choice? Yeah, McDonald's says that in this kind of context, it's pointed out that they can't, whoever is not going to be at the store can't own shares. Okay, so her shares are going to be redeemed, all right, because she gets divorced, or they get divorced, and these shares have to get redeemed, all right? And what happens? They get redeemed, and how does it get reported?
Well, that's
Well, that's not
the issue.
the issue. She does report it. That's not. So how does she report it? Well, she gets a nice check, right? She gets $450,000. What was her basis? Yeah, she reports that as a profit, right? And she reports it as a long-term capital gain. Agreed? She's going to report it as an exchange. But apparently, Someone else said, no, that really shouldn't be the tax treatment. On the top of page 250, what does the taxpayer now claim, Michelle? 259, I'm sorry. Well, why? Why does she say she's entitled to a refund? Under what code section? Yeah. What code section? 1041, which is an code section, again, near and dear to many of you, because we covered this in the income tax course, that if you have a sale or exchange with a spouse, right, no gain or loss, and you have a carryover basis under code section 1041B, right? And she's saying, yeah, I transferred it to the corporation, but the corporation was really the alter ego for my husband, right? Isn't that her argument here? And the IRS is no fan of this argument, because the IRS says, look, 1041 should only apply when there's direct transfers between spouses. It should not apply in this context, right? Did she give the stock to her husband? No, she gave it to the corporation. Everyone agree? If she gave it to her husband, clearly it would not be an exchange. 1041 would apply. Agreed? But the taxpayer, as portrayed by the court, is pretty vehement that 1041 applies. Now, how does this now unfold, Michelle? How does the court analyze this?
I guess my understanding, basically she's saying that, just mentioned, because he is sole, because he really is in control of the corporation, so it really was being given to him.
Right. There's a regulation on this that if it's made on behalf of the spouse, it can qualify. The regulations the then regulations under 1041 said that if it's made on behalf of a spouse, it can qualify, and therefore that it should qualify under 1041. The court, I think, makes a leap of faith. Now, keep in mind, what does the IRS do in the meantime? It brings a court action against the husband, right? Saying that there's a constructive distribution. Even if we lose here, there should be a constructive distribution to the husband. In your opinion, who's the better party to tax here, the husband or the wife? Christina, you're supposed to say easy, all right? Husband. But putting aside that issue, who do you say and why? Michelle. Who's the better party to tax? If you had to pick the husband or wife?
I would say
The husband? And you're vehement about it. And why, Fatima?
Because he continues with the business.
He continues operating that McDonald's. Lucky him. But, well, kidding aside, why him? Yeah, but guys, maybe I'm missing something. Who has the cash here? The wife has. Who do you want to generally tax? The person with the cash or not the cash?
Not the guy.
I mean, she's walking away with $450,000. He's walking away with half a company. I mean, he's been emasculated to some extent. He's got half a company, right? And it's worth, instead of being worth $900,000, it's worth $450,000. He doesn't really feel any richer. If anything, she's been cashed out, right? And from the divorce, in more ways than one, right? So, having said that, who prevails here, Michelle? Well, ultimately, we learn that the husband too prevails and the wife prevails. Who's the big loser in this? The wallflower in this is the IRS, who ends up losing. All right? This is not a good day for the IRS because the reality is, notwithstanding, the court, I think, talks in conundrums. And remember, I like to think that everyone in this room probably has more background now than remember, this is at the appeals court of the Ninth Circuit. And the person who rendering this decision, Judge Hugg, or maybe had one tax course in law school. So you might have, I like to think, a better tax background than this judge. I'm not entirely sure. On page 261 in the third full paragraph, the court talks as if there would be no escape from tax here in that paragraph. But at the end of the day, I think the IRS gets shut out. I don't think the IRS is going to ever collect tax on the 450 that Mrs. walked away with. So I also feel, think about the practitioner who initially said that the taxpayer here had a taxable gain. Okay, remember, right, Michelle, the taxpayer reported this as taxable, paid tax, had to sue for a refund, probably spent $40,000 to $50,000 bringing this case to the tax court and the appeals court, and prevail. So who do you think? I'm not so sure. I don't know what happened here to the practitioner, because I can see why the practitioner took this position, but in retrospect, someone would have said, "Oh, don't pay the tax and see if the IRS comes after you." So I'm not saying this is malpractice what the tax practitioner did. I'm just saying I just don't know, because what your clients might do in retrospect and say, "Gee, see, the court vindicated me. I should have paid no tax, and why did you take that position on my initial return?" I don't know what you mean by the word fault.
Well, that caused this mess. It was really, in my mind, it was McDonald's. They were the one, and then they stepped back and said, "No, okay, we got our way," but then it caused all this.
McDonald's has nothing to do with this, though.
Because they're the ones that came up and said, "You know what, if you're not married, we don't want."
Yeah, but they didn't do that as a result of the divorce. They said that's just company policy. So I think it's no. They saw not a dime from this.
No, I'm just saying, but had they not had that policy, they would probably still be in business together. This would not be an issue.
I don't think ex-spouses make good business partners. So I don't know if they would have been in business together.
I'm just saying, all in all, everyone had to figure that out.
Yeah, but let's ignore that, Michelle, for these purposes. So I don't know. I'm raising that without knowing the answer. I just feel nervous for that practitioner. Until the statute of limitations closes, I'm nervous about that practitioner. Not because he or she who prepared the tax return, my gut says, I think that's it. They took a reasonably conservative position. But the taxpayer, if they get the right malpractice attorney to juice them up, will just try to shake down that practitioner to get a $20,000, $30,000, $40,000 worth of fees. So I don't know. I can't respond to your question. I just don't know the answer. Any other? So, guys, what happens here is, do you remember from the income tax course, and some of you who had the income tax course a while ago can't remember it because it's a new case. There's a relatively new case called Mayo Foundation. It's a Supreme Court case. Justice Roberts wrote it. That essentially says that the Treasury Department can craft regulations, and since it's an administrative agency, as long as those regulations are not capricious, the court should respect it. So what has the IRS done over the years? That court case, Mayo Foundation, if you Google it, is relatively recent, but it was always understood that was the appropriate position. It wasn't. Justice Roberts was not breaking new ground on that. Anyway, in this class, by the way, this is a digression. How do you think the Supreme Court in the next week or two is supposed to come out with gay marriage? Do we think it's going to prevail? Not prevail? Who says prevail? Who says not? It's not personal sentiment. I mean, you don't have to. If you say no, it's not because necessarily you're against. it's a pretty conservative court, so I don't know if the justices are going to see it which way. But anyway, Justice Roberts was just affirming the position. So Treasury Regulations. The bottom line is that the IRS, or in this case the Treasury Department, which is another leg of the IRS, can craft regulations, and it does. Okay, it's in the material that follows. The IRS is kind of tired of being whipsawed after a number of cases where it doesn't win, meaning it loses with the husband or loses with the wife and loses with both. Okay, it's expensive and it's hard to catch. So what happens on page 264? The authors of our textbook say in italics language, regulations to the rescue. Okay, and on the bottom of page 264, it talks about the fact that if the corporation is primarily obligated to redeem the shares, if the corporation is primarily obligated, then the non-transferee spouse has constructive distributions. Let me repeat that. If the corporation is primarily obligated, then the non-transferee spouse, in this case it would have been the husband, has a constructive distribution. Conversely, on page 265, if the corporation is not primarily obligated, okay, then the transferee spouse is going to be responsible. In other words, on page 265, if the corporation is not primarily obligated, Code Section 1041, it will not apply, and the transferee spouse, the transferor, where the wife will be primarily obligated. It's going to be liable. It's going to be treated as an exchange to her. And I'm going to say in most instances, the corporation is not going to be primarily obligated. And in that being the case, in most cases, the transferor or spouse, whether it be the wife or the husband, the one who gets the cash is going to have the primary, is going to be considered the liable party. On the second paragraph on page 265, basically the IRS and the Treasury Department don't care, so you can elect, pursuant to your divorce settlement agreement, if you want to, if there is going to be redemption, you can essentially elect between the spouses who's going to bear the onus. The point is, the takeaway is, the regulations are crafted in a fashion that sort of says, we don't care. We just want to be paid by one or the other party, the transferor or the transferee. If you want to agree between yourselves who should pay, we're okay with that. All right? And there may be situations, depending on what basis the husband has, the earnings and profits of the company. It may be strategic, but many people will tell you in a divorce arrangement, even if it's strategically good for one party versus the other, you know the old saying that in that kind of context, if one party says black, the other one says white, just to make things fun. So anyway, there is this potential for an election. Whether or not it really works is another issue. So on page 266, let's see if you picked up the takeaway from tonight's lesson on this facet. Is not the case itself. The case is, in some ways, guys, just historical, here for historical reasons. The reality is the regulations now have trumped the Arnis case, right? The regulations, Arnis is really not good law anymore. We have regulations that make it in the past tense. On page 266, we have a husband and wife, a married couple on the verge of divorce. They each own 50 shares of 100 shares of common stock outstanding, a family corp, which has a total value of $1,500,000 of accumulated earnings and profits. H and W each have a $100,000 tax basis in their F stock. H and W have agreed that on the effective date of the divorce, H will own all the stock of F, and W will receive $500,000 for her 50 shares. Consider the tax consequences of the following proposals. So, again, we have, I don't even have to erase this because we have H and W. And remember, well, let's just say they each have a $100,000 basis in their stock. How they got that $100,000 basis, who knows? Could be Code Section 358, right? Vis-a-vis a 351 transaction. They could have purchased their shares and gotten their basis as a result of Code Section 1012, right? X has $500,000 of accumulated E&P, right? And we're told here that H and W have agreed the effective date of the divorce. H is going to be the winner here, so to speak. He's going to have all the shares of F, and in lieu thereof, W is going to be cashed out, receive $500,000 for her 50 shares. Suppose H buys W shares for $500,000, right? That seems reasonable. H says, I don't know if H is going to say honey, but H is going to say, and I don't think H is going to say dear. H is going to say, I don't know. I'll leave out whatever words. I will give you $500,000 for your shares. So, Christy, what happens, Carolina? See if you agree with Christy.
The wife has $400,000 capital gain under 1001, and his basis, he gets a $500,000 basis.
Carolina, agree?
Yeah. 500 basis, and 12
Panther, agree? Christina? Anyone disagree? On, say again. I hear some whisperings. Wafa. Right. What would be your authority for that? Just don't say it in a question format. What about 1041? Right? Doesn't the wife avoid, can't the wife shield herself in this context if there's no redemption and just say 1041 applies, right? You can even be divorced and you have 1 year from the time of divorce to settle up things, right? So here, guys, question A, no gain or loss, Code Section 1041. And then, right, Christy, 1041B, the husband would have a carryover basis. And the government isn't losing sleep, right, Christy, on this, because the gain is still preserved, right? Everyone agree? The husband will take over his wife's shares, right? He's out of pocket $500,000, but the company is still worth the same $1 million, right? Everyone agree? So the government's not a loser here. Say again, JP.
What would be husband's basis in wife's share?
You tell me.
So, Professor,
Say again, Angie. What would be the
so the basics for the husband's
basis in the wife's shares that he bought would be $100,000, Code Section 1041B. It's not increased. Because 1041 applies. 1041 says no gain or loss, but 1041B preserves the gain to the husband. And the company is still worth $1 million, right? So the government...
Like $200,000 in basis.
Right, the husband has overall $200,000 basis. And the government's okay because it is not and I can use my fingers here, it is not the big loser. So question A, everyone's good, right? Question B, notice the difference. Husband and wife agree that the corporation will redeem W shares for $500,000 cash. So here, remember, who is the corporation, guys? This is not tricky. It's not like, Michelle, McDonald's is standing in the wings here. I mean, it's the husband and wife looking at each other. Is the corporate enterprise. They are the shareholders. They are the board of directors. They call the shots, right? And in this particular context, we are not told that the corporation is primarily obligated, right? Everyone agree? They're going to have the corporation do it, but it's not because it's just a matter of convenience and maybe it has the cash. Now, given that and given the new regulations, in this particular context, did the husband, keep in mind who's the transfer spouse and who's the non-transfer spouse. And here the non-transfer spouse is the husband. Did the husband have a primary and unconditional obligation to purchase the wife's shares? And why do we look at this? I'll give you a cite. Regulation 1041-2A. I'll repeat. Regulation 1041-2A and B2. 1041-2B2 says you look at the, in this case, the non-transfer spouse. Did he have a primary and unconditional obligation to purchase the wife's shares? If he did, if the husband had a primary obligation to do so, then he would have had a constructive distribution if the corporation did so on his behalf, and he would be taxed. I'll repeat. If he had a primary and unconditional obligation to purchase the wife's shares and the corporation stepped up to the plate, then he's going to have a constructive distribution. If he had no primary obligation, if the husband was if he wasn't primarily obligated, then in this case, the wife would be treated as if, let me see if I can use the term of art, then she would become, just like what the IRS was arguing in the Arnis case, she would have the exchange treatment here, and he would have no constructive distribution. Right? Because she would be redeemed out, and she would have Code Section 302B3 apply to her, because she had all of her shares redeemed. Keep in mind that the parties could agree in this context. In question B, the parties could agree between themselves who should be taxed here. The IRS doesn't care as long as one party gets taxed, and the regulations under 1041-2C permit the parties to make an election. So your answer to B is it depends. It depends on whether or not the husband is primarily or has a primary obligation to purchase the shares. And we're not told that. Shahid? If he's not obligated, then it's going to be treated as an exchange to the transferor spouse. In this case, the wife. Because she's going to get the cash, there's no constructive distribution to the husband because he had no primary obligation. So the regulations take the position, in that case, the transferor spouse should be the taxing the party that gets taxed. Question C says, how would you advise each of the parties to structure the transaction? And, obviously the husbands and wives may have differing goals. Each one wants to minimize their own personal tax burden, right? And, I'm sorry? No, Wafa nailed it. You do not want to be the accountant for both, okay? And Wafa, thank you, because I'm thinking that, but it's better to say it. Because if you try to, even if you're the long-term accountant for both of them, please do not be speaking as Superman, Allie. Even Superman would not go near this, right? Superman would walk away from this and would not try to advise both of these parties, because Superman has better things to do than to be sued, right? So you do not want to be the advisor to both of these. And if you do, you really, you got to know you're going to, no one walks away thinking, one of the two parties is going to walk away thinking they lost. And that party is going to come after you with a vengeance.
One question, please. Assuming he had responsibility,
Mm-hmm.
he was a constructive distribution to his real one.
Right, of $500,000.
Right. Is there any effect to the corporation for them to report on his complex?
The effects of the corporation and the earnings and profits, because the 50% of the shares were redeemed, you would argue, or I would say half the earnings, accumulated earnings and profits at that point would disappear.
Does that happen before
I think you would do that, and then
first, and
then I would.
There's only $250 available for a dividend, and the rest is a basis reduction?
I would think so, or capital gain, 301C 1, 2, and 3. Okay. Christie's point for Kenneth in the back or Ryan in the back is that, hey, if this is a constructive distribution to the husband of $500,000, we have to take into account that the wife's half of her shares were redeemed, and that's going to reduce earnings and profits by a proportionate amount, right, Irma? 50%. And then when he gets to $500,000, we have to see available earnings and profits, because that's going to be taxed under 301C1. He's going to have a return of basis under 301C2. And to the extent we blow through his basis, we're going to have a capital gain under 301C3, right? Agreed? This gets us back to Chapter 4 again. Grove v. Commissioner. You gotta love, I have next to in my margins the word, four-letter word, but it's the word nice, not what you might be thinking. On 286, the Judge Kaufman, his first line, we are called upon once again to wrestle with the, I crossed out with my pen, the tangled web that is the Internal Revenue Code, and decipher the often intricate and ingenious strategies devised by taxpayers to minimize their tax burden. Got a nice, interesting take on the Internal Revenue Code there. So here we have a taxpayer who is going to contribute securities to a closely held business, to his college, right? And he's not cash rich, but he has shares of his closely held business that he controls. And at some point down the road, those shares are going to be redeemed. So the university is going to get, in lieu of his closely held business stock, it's going to get cash. And then they're going to use the cash to make investments. And he's going to also manage those investments. So get the visual. He contributes $100,000 worth of stock to the college. The college then turns around, redeems that $100,000 of stock, so now it has $100,000 of cash. And then his financial advisor invests that $100,000, and he gets an income stream from that $100,000. This can't be done in the year 2013. There's many more restrictions about your ability to manage contributions you make to a charity. Okay, but that issue aside, the government makes what kind of, is this what is the government's perspective? Because he does this regularly, where he makes gifts of stock to the college, the shares are redeemed, and there's a lot of cash being held on this view by the college. What is the IRS view? Is this, from the IRS perspective, viable, Christy? Why do they call it a dividend? I mean, here's a guy who's giving stock. Well, he's not directly getting the money. I mean, because he's getting the income stream. So picture, usually when you get a distribution from a company, you get cash directly. What is the IRS saying, though, here? Well, couldn't this have been reversed? I mean, let's just face it. He could have, like every year, given 1%, had 1% of his shares redeemed, got in cash, and then contributed the cash to the university, right? Picture, if you will, if he had every year, let's suppose our taxpayer has 100 shares, every year he has 1 share redeemed, and he takes that cash and contributes to the university. Wouldn't he essentially be in the same position? And with that redemption of each year of 1 share, how would that redemption be treated for tax purposes under 302? As a distribution. Don't say dividend, we don't know. As a distribution. Everyone agree? Because if you own 100 shares and you own 100% and 1 share is redeemed and you still own 100%, last I checked under B1, B2, B3, B4, you don't qualify as redemption. You're back to Chapter 4 and it's going to be treated as a distribution. If the company has lots of earnings and profits, guess what? You're under 301C1, right? Everyone agree? All right. And the IRS says that's what's really happening here. It's the equivalent of him contributing cash to this enterprise. It's all a charade. Does the court buy into that? Who prevails here, guys? The taxpayer wins. The court, if you look on page 271 at the bottom, the last incomplete paragraph, the 3rd line down on page 271. Were we to adopt the commissioner's view, we would be required to recast 2 actual transactions: a gift by Grove to the college, and a redemption by the college by the corporation into 2 completely fictitious transactions: a redemption from Grove by the corporation and a gift by Grove to the college. In other words, it's not willing to go through and recast this transaction. In the dissent here isn't happy. It says, it is what it is, but if you look at the substance, the IRS probably got it right. What happens? Essentially, the taxpayer prevailed. And in a revenue ruling, this is spelled out on page 273 in the first paragraph in the note. Revenue ruling 78-197 mentioned in the 4th line down that a charitable contribution of stock followed by a redemption would be treated as a dividend to the donor only if the donee is legally bound or it can be compelled by the corporation to surrender the shares for redemption. So as long as that's not the case, where there's no binding legal obligation of redemption, essentially the IRS is thrown in the towel and says, you want to have an arrangement like Grove? Go for it. Page 274. Philanthropist owns 25,000 shares of family corporation. The fair market value of P's family stock is $2.5 million. F's basis is $25,000. It's a meager $1 per share, right, guys? So there's a lot of appreciation in this stock. Family has 100,000 shares of common stock outstanding. The remaining shares are owned by P's spouse and children. So under attribution rules, this does not look promising, right? For redemption purposes. Agreed? The corporation has ample earnings and profits, so translate that, that means any distributions are probably going to be taxable under 301c1, right, as dividends. The family bylaws require all shareholders to grant the corporation a right of first refusal to buy their stock at fair market value before the shares are offered to sale to an outsider. But the corporation is not, emphasis on the word not, at any point required to redeem the shares. On the 25th college reunion, P wishes to make a $100,000 contribution to Rutgers University. Consider the tax consequences of the following alternative plans. Family corporation distributes $100,000 to P in redemption of 1,000 shares. Okay, P then contributes $100,000 to Rutgers. Okay, so in scenario A, is that viable? Jan, Paul, Chloe, is that good or bad? How would that $100,000 be treated? Taxable as a dividend, right? Because it's not going to qualify for redemption treatment. Agreed? So then they'll get a charitable deduction under Code Section 170, but there are limitations. What's the limitation under 170B? How much can you contribute each year to charity? Say again, Fatima? How much can you get a deduction for your charitable contribution? Huh? 50%. That's what I'm looking for. You can only deduct up to 50% of your adjusted gross income, and then you can carry forward, okay, your charitable contributions to later years. I believe, don't quote me, I think it's a 5-year carry forward. So question A, not the best way. Question B, P contributes 1,000 shares of family stock to the university. 2 months later, pursuant to an oral understanding but not legally bound, family distributes $100,000 to Rutgers in redemption of the 1,000 shares. Rutgers was not legally obligated. Does this work? Where P contributes the shares, would P have any income? The question is, does P have any income in this context? In this context, no, right? Because P never touches the money, right? Never gets P never touches the $100,000. So this is very similar to Grove. If you look at question C, it says same as B, except that P contributes 250 shares to Rutgers each in the 4 following years of his reunion. 2 months after each contribution, there seems to be a pattern here, right? And this seems a little bit more suspicious because now each year the redemption is happening. So this doesn't look as good, maybe less favorable, right, than question B, but nevertheless, the outcome is the same because, once again, in the Grove case, there seemed to be repetition, and notwithstanding, as long as there's no legal obligation, it seems to be viable. Go ahead, Michelle.
Also say because they had an oral understanding.
It's not legally bound. Oral understandings are like gifts. They're precatory. You don't have to respect them. Okay? And you know and I know. Many people, when they give money to colleges, there's lots of wink-wink oral understandings, right? About, I'll get those football tickets, you know what I mean?